I know there are a lot of you out there thinking about getting into real estate given the low interest rates, but are debating whether you should commit to it right now or wait and see how things roll in the next few months. I recently refinanced my house, but getting a new house means a new financial commitment, and a big one. So, should you wait or jump in? Let's talk about it. What's happening, everyone? Welcome to Think Finance. My name is Raj, and on this channel I talk about personal finance, investment ideas, money management tips, and all things finance. If you're new to the channel and money gets you excited, consider subscribing. So there is chatter on the street that interest rates are low and this is the best time to buy a property. In this video, I want to share some facts and figures and help you decide if it is really a great time. Let's start with talking about what's happening. Pandemic continues to take lives and have put states in lockdown mode. People are losing jobs, and if they have jobs, they are working from home. Global economies are also in a shutdown mode, and it's a matter of time before we call a recession. Fed is pushing a lot of liquidity in the market to keep the economy going. And before the outbreak, 2020 was looking pretty promising for housing. If you are in for the long haul, I'm talking about more than 10 years, then you're probably fine, and buying real estate now or later may not really matter. But here is a reality. We are all humans and we all want the best deal possible. So if waiting means the same house is going to cost you $50,000 lower 6 months from now, then it might make sense to wait. And if that is the case, then the real question becomes, is the price you're paying for a house today the best possible price you can get, or can you get a better price if you wait another few months? Of course, you need to take into consideration the interest rate as well, but I don't think that's going to change anytime soon. So then, what drives home prices? Let's break this down with some hardcore data. So far, home prices have been pretty steady. The Case-Shiller Home Price Index in the United States increased 3.1% year over year in January 2020. Sales of previously owned houses and new construction look pretty good as well as of February 2020. Yes, sale of new construction dropped a bit, but still fairly decent. What do these two charts tell us? We entered 2020 with pretty strong housing numbers. But then these numbers are pre-outbreak. We yet don't know the impact of the pandemic. Let's look at some more charts with more recent data. The NAHB Housing Market Index in the US fell to 72 in March from 74 in the previous month. This survey measures the market condition for the sale of new homes. You're starting to see a drop in home builder confidence. In the recent week, we are seeing a lot of sellers pull their listing off the market. There was a 148% year-over-year increase in delisting during the last week of March. Also, listing of new homes are on a decline, a 33% drop from the prior year during the last week of March. This means the inventory is less, which might not be a bad thing from a housing perspective as long as the demand is consistent. But is there enough demand? Mortgage application in the United States declined 18% in the first week of April, following a 15% rise in the previous week. Similar story with refinance applications. Also, the listing prices are coming down. The median asking price for newly listed homes last week was $309,000, $21,000 lower than 2 weeks earlier. And with declining consumer confidence and increasing unemployment, I'm not sure where the demand is going to come from. The latest unemployment numbers and consumer sentiment data just came out today. Indeed, Fed is expecting things to get even worse, where job losses could total 47 million which equates to an unemployment rate of 32%. That tops the Great Depression peak of 24.9%. And then, of course, with global economies in shutdown mode, it is just a matter of time before we officially declare a recession. But wait, history suggests that housing fares well during a recession, right? Meaning prices don't fall as much. Well, that is true. Since 1980, there have been 5 official recessions in the United States. If you consider 2008 Great Recession as an outlier, inflation-adjusted home prices only declined an average of 2.7%. During Great Recession, housing fell due to subprime mortgage mess, which is not the case right now. Okay, so what does all this mean? Home prices have yet not been impacted. Given the inventory is low, prices may stay put, but then demand is starting to trickle down. And with record high unemployment and shaky consumer sentiment, not sure if demand can stay up there. Here is what I'm going with. We are in uncharted territory right now. No one really knows where we are headed. If anyone out there is claiming to have this all figured out, is lying. Having said that, here is my 2 cents. Given where we are, interest rates are not going up anytime soon. So that should not be a reason to jump in. With a shaky consumer and homebuilder sentiment and growing number of people without a job, demand is not going to be an influencing factor. Indeed, with everything that's going on, demand will fall. And as we have seen in the past recessions, home prices tend to stay pretty flat or may drop a bit during a recession. All of this tells me there is no reason to hurry and lock into a financial commitment. It might make sense to wait and see how things flush out. We have yet to experience the implications of the pandemic on the economy. If Fed is right and we actually hit the crazy unemployment number, maybe you will end up scoring a good deal on a house. People would rather sell a house at a lower price and avoid a foreclosure which stays on credit for 7 years. Okay, that's all I have, guys. Thanks for watching. If this was helpful, hit that like button, and if money gets you going, consider subscribing. Stay safe, and until next time, peace.